You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
It's time for Volatility Views, the premier program for volatility traders. Each week, we'll take a deep dive into the world of volatility with in-depth analysis, trading activity reviews, strategy breakdowns, cutting-edge education, and much more. We'll also bring you exclusive conversations with the traders, researchers, and asset managers who are reshaping the volatility landscape. If it involves volatility, then you'll find it on Volatility Views. Volatility Views is brought to you by Russell Investments, home of Russell Indexes, which calculates approximately 700,000 benchmarks daily, covering 98% of the investable market globally, including more than 80 countries and more than 10,000 securities. Approximately $4.1 trillion in assets are benchmarked to the Russell Indexes. For more information on Russell Indexes and RVX, please visit russell.com/indexes. And now it's time to take a deep dive into the world of volatility. It's time for Volatility Views.
All right, everybody, welcome back to Volatility Views, the premier program for volatility traders. My name is Mark Longo from the OptionsInsider.com, as well as from the ever-exciting Options Insider Radio Network. In addition to this episode, of course, we have many hours of archived episodes available of Volatility Views. And where can you find those? Well, no shortage of places to go, including the OptionsInsider.com. Click on the Insider Radio Network tab. At the top of the page, you'll find all the Volatility Views goodness, as well as all the other dozen programs on the network you can surf through till your heart's content. Or, of course, you can surf on over to iTunes, Stitcher, Aha Mobile, wherever you find your favorite podcast programs, and download them there to subscribe. Just search for Volatility Views there, and you'll find them. Or if that's too much for you, just download the old mobile app, the Options Insider Radio Network mobile app. That's available for Android, for iOS, and for the Amazon Fire devices. So no shortage of ways for you guys to check out the show, to check out the archives. And if you have questions or comments, let us know. Shoot them in. No shortage of ways for you guys to do just that as well. And joining me on the old program today, starting off with the man beaming in from apparently not snowed under New York City, Mr. Jared Woodard, the head of derivatives over there at BGC Partners. Jared, welcome back to the show, sir, and I'm glad you didn't get snowed under too badly this week.
Yeah, thank you. What we're doing is too hot to be daunted by any kind of winter weather.
Yeah, you guys are in the headlines a little bit, given all that back and forth over the FX realm. So, hearing a bit about BGC Partners these days.
Yeah, I have absolutely no comment. Right.
I thought you were the one spearheading the bid.
Here's what I can say. I think that the use of all caps in corporate communication is an interesting phenomenon to observe. That's all I can say.
All caps. There we go.
That corporation and my grandmother.
a bit of a disturbing insight, perhaps, into the corporate world over there at BGC Partners. If you're not familiar with what we're talking about, listeners, just search for BGC Partners in Google. It'll come up in the news, and you'll hear all about it. And also joining us on the old program today, the founder of Option Pit. You know him, you love him as the greasy meatball, Mr. Mark Sebastian. Mark, welcome back to the Volatility Views program, sir.
Hey, good to be here.
All right, with the team assembled and mostly ready to roll, and mostly snow-free, we're going to dive right on into our volatility review.
It's time to break down the latest developments in the volatility trading world. It's time for the Volatility Review.
All right, everybody, welcome to the Volatility Review segment. This is indeed, as the name implies, the portion of the show where we break down the week that was from a volatility trading and analysis perspective. And what a week it was when you look back at it from an overall vol perspective. We are recording this today on Friday, 1 p.m. Central, right here on January 30th. So bear that in mind when you're listening, playing the home game there, listeners. And so far, it's a bit of a mixed day on the old street. S&P selling off, Q's rallying a bit, and the Dow selling off a bit as well. VIX Cash getting a bit of a bump, up 1.25 points to just a hair over the 20 handle. And that's kind of going back to the north after it's been a bit of a weird week for the VIX. We started off the week in a bit of the old the lows, the old doldrums, whatever you want to call them. Hit a low of about 15.5 earlier this week in the old VIX Cash land. And we saw it spike as high as about 21.5 in the latter portion of the sessions. We'll see if we can get there today. We're still a bit of a way from those levels, but it's been interesting to watch. Of course, a lot of movements in the resulting underlying as well. We're in the height of earnings season, so we're seeing that throwing a lot of volatility in the mix as well. So it's been a fun time to be watching the markets. Perhaps, Mr. Woodard, we'll start with you. What caught your eye in particular in the week that was from a volatility perspective?
I think that the persistent bid in a lot of places for options is pretty notable, and the fact that the average level for VIX so far this year has been around 19 just kind of supports the outlook that I had and we've had on the show, and a lot of folks have had for this year, which is high levels of vol and quite a lot of it when it comes, and maybe a surprising amount given how strong economic data in the U.S. has been, but still consistent with what we've been expecting so far this year.
A lot of people were putting out those predictions. And of course, we were on the show as well, that it seemed like it was going to be a relatively quiet year from a vol perspective. And then all of a sudden, the markets were off to the races. Vol was off to the races. Vol was off to the races. And a lot of people were left scrambling to say, hey, what's really going on? Goldman kind of famously put out their prediction for a tranquil volatility year so far this year. And then when everything started taking off, we saw them issuing a lot of research notes trying to back up their predictions, saying these are kind of aberrant moves and we should be settling down any time now. And maybe we'll see if we get that settling. It certainly hasn't come in yet so far this week. Mr. Sebastian, what caught your eye out there in the week that was? A lot of grist for the mill this week from a vol perspective.
Yeah, I think the big thing is realized vol's really been hanging in there. We've been moving 1%, 1.5% a day. Average true range has been, just extremely elevated. And, there seems to be a pretty strong bid for VIX or, for volatility when we see VIX kind of fall into the 16s. And, it's interesting. We've had wild movement, yet little actual movement, up or down in the underlying. Is, like S&P's been pretty range bound. Within that range, though, it's moved a ton. So, it's the difference between kind of high volatility with little momentum and low volatility with lots of momentum, or vice versa. You've taken a lot of heat selling strangles, but you've probably been all right because the market has, in fact, been range bound.
Yeah, that's true. The numbers would make it seem like it'd be a less than favorable environment to be blasting out some strangles, but you're right. If you sweated through some of those extreme moments, you probably did all right this week. Looking at the week that was from those numbers, 30-day vol out there in the S&P land hovering right around an 18 or so, which is about a point over what we're seeing from a 30-day historical. So a little bit of a premium there. It kind of vacillates back and forth depending on the day. A point premium, a point discount. We'll see what it is going through to the end of the day today. Not looking as skew heavy as some people might assume out there in the broad S&P as well, hovering right about a 130 or so, 130 half in that so fun, ever so obtuse Skew Index. But if you've been watching it all of late, listeners, it's been gotten as high as into the 140 range and as low as into the low 120. So we're kind of in the middle of that range right now, showing a bit of premium to those puts, but perhaps not as much as you might expect. And certainly, we were talking about Goldman before, you're talking about put premium. Goldman at least coming out saying, I like the term, I think Steve Sears and Barron's wrote about it, called it, they said it's nap time for put sellers out there, saying that they're telling their clients that what they said put selling, of course, which has been a great trade, and they say is one of the best trades on Wall Street since 2009, is no longer as attractive to them. Of course, getting into a lot of points we hit on this show many times. VIX declining, S&P up a little bit, and 1 month out of the money, 5% or so puts. They're selling as what they call median levels out there relative to the past 18 years. So the hunger to go out there and blast out a lot of downside puts certainly isn't perhaps there. And that's kind of backed up by what we're seeing in the skew numbers out there. There's a little bit of juice out there to them, but nothing perhaps to reflect what a lot of people think is a relatively broad concern out there. Markets are still a little top heavy. We've sold off a little bit, but we're still fairly top heavy, certainly given where we were a year ago. We're top heavy. So not as much concern out there as you might think, and hence not enough incentive to go out there and start blasting out some puts. Mr. Woodard, what's your take on this Goldman research? Do you concur, sir?
That there's nap time for put sellers?
Yes, I like that term, nap time for put sellers.
Yeah, I mean, you can't really have a long vol kind of outlook for the year and be a huge fan of aggressive put selling, certainly not in a systematic way. That's been my view. And that's worked out well since early October when we kind of switched to that mode. I think there's still opportunity for tactical, discretionary kind of trades, and especially in single stocks and sectors. Maybe not at the index level right now, but given at least my outlook for more volatility driven by changing rates outlook and other kind of issues, I think that you'd have to be incredibly aggressive and nimble to kind of have a short put approach on this year. It seems like it's not the right time for it, honestly.
Yeah, there are a lot of factors, I think, compiling not just the relatively low level of premium you're collecting, but just also your general market outlook. If you're one of these people out there, like many people who are concerned about a near-term retracement, then aggressively blasting out puts at median levels is probably not the best strategy for you. Talking about the vol out there as well, things like we're seeing out there. And VVIX has been moving quite a bit of late as well. It seemed to hit a near-term trough right around the 90 handle of late, and ever since this week it's been spiking up, edging up ever so slightly every day, up at about 105 right now. So volatility of VIX is still had a nice bit of a range of about 91 to nearly 110 this week. So it's been a volatile week for the volatility of volatility this week, which is also an interesting thing to watch. VVIX is always that weird indicator, fun to keep an eye on though. And of course, in terms of going straight into VIX land and what's been trading out there from a straight up options perspective, like we mentioned last week, those trades coming in are going to start changing the landscape a little bit. It was very anemic last week from an overall volume and open interest perspective. Of course, that was post settlement, so post expiration. So we have issues there that the open interest usually gets trimmed very aggressively. It got trimmed even more so going out of last week. It's starting to pick up again this week. We're seeing about a little over 4.3 million options open out there in VIX land, with the number one spot being the Jan 20s with about 423,000 open. That's a substantial increase from what we saw last week. Remember, listeners, we were talking about the hot strike out in VIX land being 100 some odd thousand contracts. So clearly a lot has changed. Of course, the Jan 30s also a hot contract with about 250,000 contracts open out there. Then it kind of falls off a cliff in the number 3 spot. The Jan 15 puts 137,000. Jan 22 calls 117,000. Jan 21 calls the number 5 slot with 110,000 open. And then it drops even further, 102,000 for the Jan 17s. And then we get all south of 100,000 for the rest, about 99,000 down to 84,000. For the Jan 17 puts, 27 calls, 18 calls, and 16 puts respectively. Again, totaling up for about 4.3 million options outstanding, just a hair under 3 million on the call side and about 1.3 million on the put side. So not as call heavy as it has been in the past as well, perhaps reflecting a bit of that vacillation we've seen out there in VIX land, as well as that little bit of inflation. There's actually some room to play in the puts these days. Talking about other vol products out there, there really isn't a hell of a lot to talk about from a straight up equity index vol out there. VXST, our favorite whipping boy here on the show, once again having I think anemic is a charitable word to describe it. Many days with zero volume out there, and some days with like 25. So still having a lot of challenges really grabbing hold of any sort of mindshare, retail or institutional, and say, hey, come play with me over here. The big indexes are moving. The big products, VIX and SPX, are certainly doing well. SPX weeklies, other short-term products are doing fairly well, yet none of that, literally zero of that paper is migrating into a VXST. Still a weird one to watch. RVX also having similar problems post-expiration and settlement. They're really getting a lot of traction out there, not much open interest cooking out in that land as well. Speaking of lands, Jared, I know you look farther afield and just what's cooking here in our little domestic shores from a vol perspective. And certainly there's been a lot cooking out there of late. We saw the ECB action. We saw the Greek elections. We had, of course, the Swiss franc fallout still hitting a lot of places. So what's been catching your eye out there from an international volatility perspective over the past week?
A couple things are notable there. You've got implied vol in the Eurozone's fallen a bit on the back of that news, and also East Asia is fairly cheap. If you look at the number of standard deviations from the 1 year mean, I know that like 6 month swap rates on variant swap rates on South Korea and some other countries in East Asia have been extremely low for quite a while. And you can, if you look at like even 3 month implied vols in some of those spots, they look comparatively cheaper. So like in a percentage rank terms, Japan, the Nikkei is near median levels. The Hang Seng in China is near median levels. So even though the U.S. is priced pretty aggressively in terms of option premiums right now, a lot of places around the world have come off quite a bit.
And Mark, I know you mostly focus on domestic, but you've been paying attention to a lot of international products of late, including indices out there in Brazil and others. Anything catching your eye over the past week from an international volatility perspective?
I mean, Russia is just imploding. The ruble is all over the place, and you've got all sorts of problems in some of the emerging markets. I mean, there's this currency move, might do a decent job of outside of like a Brazil who's very oil rich, big oil producing companies. I mean, this rally in U.S. currency, long term could be real good for them. Yeah, I wanted to make a comment on the Skew Index, and you'd mentioned that it was kind of, that 1.3 not particularly high. I think one thing people need to recognize is that part of the reason why Skew exists is because people, is that, relative to kind of at the money volatility, people see protection as somewhat cheap or somewhat expensive. So when you see kind of vol low, but people are buying out, but you've got a steep skew, what you really expect to see then is, you expect to see skew flatten up, and where you really will see it is typically more at the money vol increasing, which is what I think we're seeing here, than that out of the money stuff, decreasing. So what I really think the reason why the Skew Index is maybe not in the 140s or the 150s is that at the money vol is kind of caught up to where out of the money put protection was already trading.
You're saying things are a little bit cheaper anyways. People are going to migrate their liquidity a little bit closer to the at the money because they can?
Yeah, I mean, well, when you get that, people buy way out of the money further out of the money stuff when volatility tends to be cheap. I know it sounds kind of counterproductive or counterintuitive. And then when volatility rallies, what you'll typically see them do is, they'll migrate out of their maybe out of the money protection and into something more at the money, or they'll trade around it. So you'll actually see people, in addition, on these sell-offs when vol increases unwinding part of their protection. A hedge isn't really a hedge unless you actually use it.
That is one of your favorite talking points over there at the old pits. Use your hedges. And it's interesting to see, you're right, there certainly are a lot of structural things at work out there to keep these skew levels relatively low. I think the shape of skew will be a good topic to talk about a little bit when we have a listener mail that gets into that in a little bit. But before we get into that, there's a lot of stuff afoot out there, as always, certainly as of the past few months out there in the commodity landscape. Let's kick it off with oil as well. It's been another interesting week, shall we say, for oil. Of course, we saw the former head of Saudi Arabia pass away. Then we saw a Saudi prince come in and reiterate his stance that we'll never see $100 oil again. That made a lot of headlines, as you might imagine. Then an OPEC chief following that up saying, hey, this may be the bottom, maybe trying to talk up oil a little bit. At the same time, we're seeing some big producers starting to talk about cutting some of their investments in future research, perhaps trying to ring the alarm bells and talk up oil a little bit again. Of course, these firms are out there actually selling forward futures to finance a lot of these investments. And if the futures are dropping, well, then they're not really getting what they used to finance a lot of those investments. Hence, they're cutting a lot of them. And of course, we talked on the past on the show about how for a while there, oil was very, very put heavy. The skew was all puts all the time. That has reversed over the better part of the last few months. Not reversed completely, but changed. Whereas people are starting to pile into the longs. We talked about that recently. About a month ago is when we really first started seeing that oil really getting into around the 60 handle. So is when the longs and the bulls started diving in, saying, hey, there's going to be a retracement. We saw the commitment of traders in the CFTC backing that up, showing a lot of shorts switching to the long side of the fence. Those people have all been burned very badly over the past month as oil has continued to sell off. We're still hovering with WTI south of the 50 handle, around the 47, 48 range or so, I believe, today. And so we're looking at the latest commitment of traders reports. Seems like maybe some of those bulls have kind of backed off a little bit too. We're still seeing the net long positions increasing out there, according to the CFTC. This is, of course, from the period from middle of January, essentially, from the 13th of January to the 20th. Of course, CFTC data is a bit lagging in that sense. That's over the same period where WTI actually increased a little bit, from about 45.5 up to about 46.5. But still, we saw just a slight increase in overall long positions, about 5,000 net contracts. Of course, they're netting out options and futures in there. Of course, the decrease in shorts is also interesting. So a lot of shorts starting to curtail as well. So if you combine those two, then we saw a net overall change of about 5,700 contracts. Again, nowhere near as large as we've seen in previous reports coming out of the CFTC. Again, maybe some of those bulls having felt the sting of jumping in a little bit too soon, and they're starting to perhaps measure their response and say, hey, it's possible oil could be vacillating around here for quite a while. Maybe now I don't need to jump in with both feet right at the moment. We're certainly seeing that in the options as well. There is obviously more bid to the call side of the skew, but nowhere near as much of a turn as we saw in about a month ago or so, where it seems like everyone and their mother started discovering WTI and regular crude calls. Mr. Jared, is this data kind of jive with you as well? What's your take on what we've been seeing out there in crude vol over the past week?
It's interesting that even though the price momentum has really slowed, option premiums haven't quite fallen very much. I think WTI is down like maybe $1 since January 13th or so, middle of the month, and so we've seen what my chartologist technical analysis friends might call like bottoming action. I think the rate of momentum has certainly slowed to the downside, and so in a normal situation, maybe looking at a stock index, you might think, well, if the underlying is kind of flattening out, we'd expect option premiums to start to decline. But we're not seeing that. A lot of these options in crude at different levels of moneyness are still at or near recent highs. So it looks like there's still quite a heavy bid for vol there. And I think as there's some justification for a long vol outlook in the energy sector. Chevron, I know, announced today that even though the earnings were okay, they were suspending their stock buyback and trying to cut. They couldn't actually cut very much. They don't have the kind of flexibility as some of the other majors, but cut their spending as much as they could. So we could see another shakeout in the oil patch as some of the high yield credits that people really dumped earlier have actually seen flows back in. I know that some of the regional banks as well still have exposure, and there's no reason that if employment data comes in well and it looks like a summer or third quarter rate hike is in the cards, that kind of pressure couldn't cause another kind of an episode. Not it's not subprime, it's not some kind of a major risk to the market at all, but internally to those to stocks and companies in that sector, I think that there's still some risk people are really worried about, and that's probably what's driving option prices still.
And Mark, I know you look a lot at USO, of course, OVX, still kind of range bound. Kind of seems to be bouncing, vacillating between the 50 and 60 handle for the better part of the past few months. Can't really seem to find any momentum out there. Anything catch your eye either out there in the big crude vol or in USO, some of the other ETF options?
One thing that I thought was interesting is we had that just abysmal inventory report this week. We had one bad day of selling and then basically recovered over the next couple. We recovered a piece of that over the last 2 days. So, in the past, when things were really looking bleak, you would have seen 3, 4, 5 days of people jumping over each other. I think a lot of the people that need to sell oil have done so, and the people that were kind of banging longs at the 70 and 75 level that were kind of puking are out. So if you look at where WTI is, you look at some of those option premiums, they're starting to look pretty. With vol here, some of those option premiums are starting to look pretty sweet, not light and sweet, if you will. But yeah, I mean, we had another nice pop in oil today. I mean, let's just take let's look at like April options with April crude around 48. If you look at where the premium, some of the option premiums are, you can get over $2 for you can get the 45 puts settled $3.22. The 43 puts settled above $2. So there is some serious premiums in some of these options. Moving it into March, I mean, March 43 puts settled $1.54. I mean, at that level, do you mind buying a barrel of oil for below $41.50 at the 43 strike? I just don't see that happening. It looks like a real decent risk reward trade now in a lot of these option premiums. I don't know, Jared, have you looked at any of these? I mean, they're starting to look pretty juicy.
Yeah, I take your point. I agree. I think that there's just, it's a tricky thing to play. I think I'd rather either figure out a view on the commodity itself or get really selective at the, looking at equities. Some of the upstream guys and the exploration companies seem like they're still really exposed if there's any kind of a second leg to this. But maybe some of the integrated companies are more, better positioned. I know that the earnings in some of those big companies have been pretty good at the level of downstream revenue. So it may be that they're going to weather this better and maybe even get a chance to pick up some smaller companies in acquisition terms later down the line. And then, on the commodity itself, I think that there's still quite a lot of kind of a waiting game on how far OPEC wants to go and how far they want to push this. So, I agree that the stuff is really quite expensive, but not for no reason. So I think I'd have to look at it as a relative value kind of a
maybe a front spread would be an interesting trade, because there is a nice skew curve under there too. As I look at it, I could think about this, Jared. I could buy the 43, 42, the 45, 42 and a half 1x2 and get paid on it.
That's interesting.
That is interesting, isn't it? And that's March.
The other thing is that I think that a time spread might work if.
That's not a bad idea either. If
this little lull gets another several weeks to it, even if you're worried about another leg down or another kind of blow up from financing issues in the summer, you could sell something now and hedge it with long vol later on. Straddle swap or strangle swap, something like that.
It's a good idea.
So, Jared, you're saying that regardless of how much juice there is in those out-of-the-money puts, recent price action is going to keep you from blasting away at those.
Well, it's not like commodity markets aren't like equity index markets. Every futures contract is kind of its own little kingdom, and every expiration, and the liquidity is different too. So if you're trading stuff on the screen, sometimes the spreads are wider. I think there's a lot of reasons why an aggressive. I mean, there's like, for example, there's a good reason that you don't have like systematic option selling strategies in commodities. A lot of times the same way that you see in equities and equity indexes. So, so I think you have to be a lot more tactical, a lot more careful with these.
Well, and let's get into some of those tactics, because it is time now to check in on the volatility voicemail.
It's time to share your thoughts and opinions with your fellow volatility traders. It's time to check the volatility voicemail. Make your voice heard by dialing 779-669-4VOL. Posting a comment on the optionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider.
All right, everybody, like the man said, this is the Volatility Voicemail segment. It's a portion of the show where you guys get to take the reins, ask your questions, make your comments, give us all your deep volatility insight. No shortage of ways for you guys to do just that, including all the ways he just described. If that's too much for you, just get the mobile app. It's all baked into there. It's much, much easier for you. All right, first question comes from a listener, NINC, NINC, however you want to pronounce that. You never know with these handles. He writes, "Hey, Volatility View guys." Well, hello, NINC. He goes on to write, "I know you've discussed the topic of earnings studies in the past, particularly as it relates to earnings straddles. You said there wasn't much research on the topic. Has the situation changed since that conversation? Has there been any new research on the topic? I know you discussed the possibility of doing such a study for this program. What is the status of that study? Please let me know when you release it, as I would be very interested in the results. Thank you for this network. I'm a regular listener of Volatility Views, Options Bootcamp, and the new, I think he meant news, the news rundown programs." Well, Mr. and Mrs. NINC, thank you for your comments. Thank you for listening to the network. We love you guys. Pick whatever shows you want. We're not partial here. As long as you listen, we don't mind. And this is, of course, if you missed it, listeners, is referring to a kind of an ongoing discussion thread we've had on the show for the better part of the past couple of years, actually, is the relative dearth of actual data out there when it comes to studying a topic you think would be important to a lot of people, how underlyings perform versus their straddles versus implied volatility going into earnings events on the equity side. There's a couple of big studies out there that was done by Goldman, and that's kind of really about it when you dive into seeing how big Fortune 500 companies and others really perform versus their straddles on a quarter-by-quarter basis. And if you've been listening to the show for a while, you know I gave Jared a bit of a hard time. I think that's what NINC is referring to here when I told him, "Hey, Jared, why don't you do the great big straddle study and settle the debate once and for all?" You'll be happy to know, listeners, I've been giving him a hard time for it on your behalf. It's not like he has anything else to do, better to do at least over there at good old BGC. So, Jared, on behalf of our listener here, he wants to know, what is the status of your great straddle study? When are you going to come out and actually answer this question for us once and for all?
Oh, it's all done. I just published last week, and the results were that, in fact, on average, neither buying nor selling straddles ahead of earnings yielded any profit whatsoever. So we can put that to bed and never talk about it again.
Mark, selling them up the river like that, that's incredible.
No, I have no news for you whatsoever. I do have a spreadsheet and half of a script I wrote to start pulling some of this data. But it's just, for whatever reason, not at the top of the list.
Well, I mean, there are a few Goldman studies out there, and every study that comes out basically states that it's a myth that unloading copious amounts of premium is an easy way to make money in earnings, like is often pitched by your shucksters out there. We've seen, look at what happened this week, right? We saw Facebook come in as a complete dud. We saw Google come in as a dud and then take off in the afternoon. We saw Amazon have its straddle price at the cheapest level in a year, only to blow that straddle by, a 3x. Apple came in about in line. I mean, it's been a complete and total crapshoot. And these are active names that should have relatively, that quote unquote there's enough players that where price discovery should come in somewhat in line, and we can't even find something in those names. So I think that goes to show you kind of how why there's no real systematic way to trade around these things. I had a guy, actually, this is a funny story in Apple. And what he used to do is, and he told me, he's like, "Oh yeah, I've got a foolproof system." And I was like, "Oh yeah, what's that?" He goes, "Well, I sell calls ahead of earnings 100 points away." Well, and then he did it in the one earnings where, remember that one earnings where Apple moved over like a 2-day period, like $185?
Yeah, they blew the doors off of it.
Yeah.
Yeah, I remember that.
So, that's just it. There's no easy money in earnings. There are, I think that's about the only time where, as a percentage, premium selling is not the win, right? Jared and I will tell you that, at any given time, 50 to 60% of options are overpriced, 20 to 30 are maybe fairly priced, and 10 to 20 are going to be underpriced. When you get to earnings, it's more of a 50-50 probability. It's actually harder to pick, in my opinion. And as exciting as earnings are, I think, especially from the retail standpoint, don't waste your time.
Yeah, I mean, I think there's a good thought process we can follow here to save some time. And you can do this with just about any research question in advance of all the empirical work that might be really onerous or expensive or take forever. You can a priori think about what would have to be true or what you'd have to know to really find something valuable. In this case, you'd have to know what the option market tended to price into stocks, what the average move was on, say, the day after the earnings was out for all these stocks. You'd have to know, ensure that you limit things to liquid enough options where you could execute in a way without losing all your edge if you found one. And it would be helpful to know if companies were, what the relationship was between the average move and the sort of surprise or disappointment in company earnings. That's a lot of variables to keep track of. And what I think you would find if you actually did all the legwork on this is that the change in the economic cycle, changes in investor flows in terms of where liquidity is going and where kind of the hot money is going, and other big picture economic trends may have a really big impact on the performance of any strategy that you were able to kind of put together. The second thing I'll say is that just, presumably the outcome of this, let's say we do this study, we find out that, hey, straddles tend to be, over the very long term, over a big sample, overpriced or underpriced by 1 or 2 or 3 vol points, such that you should always just systematically sell them or systematically buy them or whatever. If you commit the capital to do that and commit to all the execution required to implement that, you might come away with some kind of an abnormal economic profit. It's possible, but wouldn't it be amazing if you could, put your thumb on the scale just in the slightest way with some fundamental research to form some kind of a view, if not on individual companies, at least on industries or sectors, because these big surprises and big disappointments tend to group together a lot. And then that way you could avoid a lot of the noise. And I think that, so my point is that I think that the real path forward here, from a research point of view, and the reason I actually haven't tried to do the studies, I think that there's other more efficient ways to take advantage of over or under priced earnings and options. I mean, one little thing that we actually have been able to do lately is look at what the average move has been in the last 10 quarters or so for a stock ahead of earnings. I mean, how has it moved after earnings? What have the options priced in ahead of earnings for that particular stock? And so I'll look through, when companies have earnings coming up, and look for any options that look like they're abnormally high or abnormally low relative to, what the options usually do versus what the stock usually does. And lots of people do some kind of this type of thing. But, if you look for things that really stand out or unusual, then I think you can eliminate a lot of noise and a lot of churn that you might get in your trading. So we publish that in like a daily note that comes out during earnings season, any ideas that I come across. And I think that saves a lot of time and effort versus some kind of a, four cannon, really big, systematic kind of an approach.
Well, we've kind of touched on it here many times here, but the next question is very much related to the first, so I'll just go with that. Hopefully that answers your other question there, Mr. or Mrs. NINC. Doesn't sound like that straddle is coming anytime soon, but Jerry laid out some interesting other alternatives to the blanket general straddle study. This other one comes in from Andrew S. We just touched on this. He writes, if you had to lean long or short going into earnings every cycle, which way would you go? Me, I'm tempted short, but I'm terrified about the blowout events. I think you just summarized it very nicely for the lion's share of the listeners out there, Mr. Andrew. The temptation, of course, is to come in short and collect that implosion of premium that typically happens after the big announcement. I've often referred to it as a balloon in the past, and that balloon pops and all that juicy premium comes in, and you can just harvest it. The problem is, of course, what you mentioned and what Mark just mentioned, we saw displayed this week yet again, though, those blowout events, when they happen around earnings time, they could be very sizable, and just a few of those is enough to pretty much wipe out all of the other ones that kind of just sit at the strike and perform well and nicely and ideally for you. You can get 10 of those and you can get one, like Amazon or Apple, like Mark just described, or Google recently, or Amazon, or any of the other ones, and all of a sudden all of those wins are gone and probably then some. So it is a terrifying thing. That's kind of why I like, we talked about it before, Mark, that strategy you guys really like over at Option Vol, I think is good for a lot of Option Pit, I should say, and it's really good for particularly a lot of the retail listeners out there who have a difficult time really trading this stuff effectively and can hedge in the after hours with options and things like that, is, of course, to just trade in the weeks leading up to it and then wash your hands of the event completely, because either way, it's terrifying. Being a long premium through that whole event is going to be a roller coaster. And if you saw what happened with Google this week, it ended up working out, but for a while there, it looked like premium holders, premium buyers are going to be screwed because it dipped down, then it rallied back and it took off again, and you missed your opportunity to hedge really well. And the short premium guys, of course, it's a terrifying night for you if you're riding it through there. So you're probably better off either side of the fence, just washing your hands of the event and trading in the weeks prior. Is that pretty much what you guys advocate over there these days, over there at the pit, Mr. Sebastian?
Yeah, I mean, we really like using the earnings week as an anchor for, time spreads and things like that. But like the diatribe I just got done saying, I think there are way better places to find edge than in playing earnings. So what I would say is, how about rather than lean long or short, I lean zero and don't do it. I haven't done an earnings play in 3 years, I don't think. So that's really how I feel about stuff. It's a waste of time.
Jared, I'm guessing you fall pretty much on the same side of that fence.
Yeah, I mean, generally speaking, I wouldn't be ready to just flip coins right and left. I think, as I said before, I think that if you have some kind of a view on the fundamentals, then I think that sometimes there's room to do that. And if you look at where some stocks, the people who really have interests to trade around the earnings, sometimes you find stocks that tend to be a little bit overpriced ahead of earnings or underpriced. And if you see that tendency and you have a fundamental view, I think it can be worth trading in those circumstances. But that does require, like with any other trade, it requires a good bit of legwork, and it's not the kind of thing you would just sort of put on systematically.
All right, we're going to close out the Vol voicemail here with a question from Nitin. This comes from over there, Stock Twits. I don't mention Stock Twits enough here on the show. We are Options Insider on Stock Twits. I know a lot of you like to use it. If you want to hit us up on Stock Twits, go ahead. We can always route your question to the appropriate program as well. So factor that in with the Twitter and the Facebook and the email and the website and everything else and the mobile app. And no shortage of ways for you guys to get your voices heard here on the old Vol Views program. And like Nitin writing in, we talked a lot about earnings this week and Goog in particular. And he writes, funny how Goog moved yesterday. Apparently the skew was bid up all day yesterday, so not a surprise. He put in a great little chart here. It's hard for you guys to see it, listeners, but his chart shows pretty much on the near term, the near expiration months of the options, heavy on the call side of the fence. I think that's what he's referring to when he means bid up. Typically, skew is the terminology is done regarding the puts. So if you say the skew is bid up, you mean the puts are heavy. But in reality, I think he meant the calls here, and clearly this chart is reflecting that. The rest of the farther off months seem fairly equidistant, actually, in terms of volatility premium. So it's just the near-term months that showed, as you might expect, the significant earnings bid to the calls. And we saw that reflected in the underlying movement as well. It seemed like it was going to sell off pretty aggressively. It was down about $10. If you listen to our option block program, we discussed it live as it was happening yesterday. It seemed like it was going to be a resounding bad result for the Goog folks. And it kind of turned around from there and rallied yet again, made back that $10 and made back a lot more As we speak today, it's up $28, almost $29, about 5.6%. So about a $38 net round trip or so from where it was. So very, very aggressive moves on the upside. Our friend here, Nitin, saying that is being done by the skew and people that skew driving the underlying up north, reflecting all of that bullish sentiment out there in Google. Either way, it was interesting. It seemed like people were going to be very disenfranchised in the early part of that earnings, and it turned out to be a bit of a home run, at least from the premium buying side. Mr. Sebastian, what do you have to say for our friend here who thinks that the reason Google is rallying is because everyone and their mother was piling into calls yesterday?
I mean, that's a little counterintuitive. But I mean, you can definitely see stuff like that, but that could have easily been people hedging shorts. And in fact, sometimes when people pile into calls, when the market makers go in and have to hedge it, or when the big firms go off and have to hedge it, that can really be a sign to that can cause the underlying to short. And really, if you think that skew is that steep, then it should be sold and you should buy something nearer the money. I do not find skew to be predictive of underlyings other than basically indexes. It's about the only places where I've seen skew be extremely somewhat predictable.
Yeah, it's very rare that we see skew act as a magnet like that out there in some of these names. And you're right. The question like this is kind of forgetting the institutional market maker side of that, who have the other side of that and have to hedge that, and all that short gamma may actually contradict a lot of what you're seeing going on out there. Good question there, Mr. Nitin. We love to hear you guys over there on Stock Twits. It's a smaller community, but very, very motivated. So get in there, join the party, join the fun. We love to hear from you. Of course, find us on the website. We'd like to try to surface some Stock Twit ones every now and then, too, just to let you guys know that we haven't forgotten about you. Get a lot of questions in there, and for whatever reason, we always talk about the other big outlets, not the twits as much. So go ahead, surf on over to Stock Twits, follow us there. A lot of our stuff goes out there as well, links to the unusual activity and stuff like that, and of course links to all the shows, so you can check it out all there as well. And I'm sure there'll be a lot more discussions about earnings and volatility skew coming up, because we still have a lot of big names to come out, and earnings season as always provides a lot of great grist for the mill for that sort of conversation. But now it's time for us to keep on rolling right on into our final segment. Yes, it's time to check out the crystal ball.
It's time to peer into the future and reveal what the volatility gods hold in store. It's time to look into the crystal ball.
Well, listeners, you guys know that as of last week, we still have a raging bet here as to who will be the first one to buy me a nice, delicious steak dinner here in scenic and lovely Chicago. But we have to get some people wrote in. I forgot to surface those to see what they wanted the bet to be. We'll have to compile all of those for the next episode, and we'll see what the listeners determined as to what they think the actual stakes should be. As long as it involves buying me a steak in there somewhere, I'm fine with whatever the listeners determine. Maybe Mark we'll flip the script. We'll go with you first. What's your wild prognostication for the week to come, in addition to buying me a steak?
I think we see more pressure on the 10-year note, with the data starting to come out as it is. And all these corporations really complaining about strength in the U.S. dollar. I think we're going to start to see more and more pressure on the Federal Reserve. I think right now they don't know what the heck is going on. They're not sure what to do. We're in a really rare environment where we've got economic growth and we've got really deflationary pressure in a lot of different areas, and really kind of a oddly and quickly in an almost an unhedgeable fashion rallying U.S. dollar. So I think the Federal Reserve right now is looking around and is a little flummoxed. So for the week, I think we'll probably hear. Are there any Federal Reserve governors speaking next week? Because if there are, somebody's going to let something slip that's going to cause a big rally. Today we continually and consistently are bouncing off the 100-day moving average. Like it's been pretty incredible. We're essentially resting there right now. So I like things to kind of continue along this path, bouncing between 2000 and 2060, and the VIX bouncing between maybe 16 and 21. I think next week we'll see a 16 print, and we'll probably see another 20 print.
And Mr. Jared, what do you have to prognosticate for the week to come, sir?
Well, okay, so GDP came out today, and the employment cost index for the fourth quarter as well. And I think that I think reaction was kind of mixed. But I think the GDP figures were actually much better than they looked. And I think that the Fed has kind of become resolved on the things that are going to make them move, like what they're looking at, what they care the most about. So I think that they know what they want. Bullard, I think, was out today saying that he thought that he was actually restating the case for June, even a June rate hike, saying that 0% was just not appropriate given the kind of growth they're seeing. And I think that the thing that Yellen, who's obviously more moderate and even-handed, is most keen to watch is wages. And so the employment cost index up 0.6% for the quarter, last quarter, was in line with expectations. It was a tick lower than third quarter. But what I think is the most important thing to watch is elasticity of wages relative to the job market, because we've had so much of that, what they call pent-up wage deflation for the last several years. And because the recession was so deep, there's been more of that than we'd expect. I think that on the upside, it also makes wages much more responsive once you start to get real pressure and a shortage of skilled workers. The analogy that I think works best here is think about employers as being, short gamma, like short upside calls on labor costs, and the underlying for those short calls, skilled workers, are becoming increasingly scarce. So the lower unemployment goes, the more the labor market tightens, the more exposed employers are to have to suddenly be paying progressively higher wages to get the people that they really need, especially in middle and high income type jobs. So I think we could see employment cost index surge significantly higher. There's a bad, kind of really low print that's going to drop out shortly. And if you look at the components of GDP, this for the fourth quarter, I think there's some good reasons to think that they were a little bit lower than revisions would suggest. The trade. I won't do the professorial like formula or anything, but the trade balance, exports are probably going to be revised higher. What's the I? Investment was already seeing energy reductions from energy producers, and that should balance out. Manufacturing from Chicago, the index today was actually quite good. So let's call I a neutral. Government spending was significantly down. That was one of the big drags on the figure for this quarter. Most of that was defense cuts, and I noticed that the president and the establishment Republicans seem to be on board with some big increases in defense spending. I think the White House budget for the next budget is like a 7% increase actually in defense spending. So that drag might actually go away. And that leaves personal consumption as the big driver. And we saw consumption jump 4.6% in this release, a huge increase. That's obviously, that's 70% of our economy. And that so dwarfs energy, exports and imports, anything else that somebody might be worried about. I think that the consumer is like roaring back. We're just starting to see the benefits from the oil dividend. A lot of those savings over the holidays were actually saved, not spent. And so I think that in a quarter or two, we're going to be looking back at this time as the chance for, this is the chance for employers to get skilled workers at still relatively depressed wages. And it's a chance for consumers to get good deals. I'm not any kind of inflation hawk or really looking for massive upside by any means, but I think that growth is really great. Demographics, household formation are all like turning in the right direction and moving in the right direction. And so I think that the reason I'm long vol for the year isn't because of downside risk, it's because I think that the Fed's going to end up hiking rates before the end of the year for sure, and that it's going to change the dynamic, change the costs for people, and put pressure on margins because things are going so well. You're going to have some wage pressures. It's going to change the mix, and I think it's going to cause some churn. But overall, I think it's really positive, and international risks are what they are, but we're used to those, right? We've had those for years.
That's a good analogy, too. I like that. The employers being essentially short calls on the upside there. I think a lot of our listeners can relate to that. Well said, sir. And that's unfortunately all the time we have for the Crystal Ball segments. Also all the time we have for this episode of Volatility Views. But before we go, as always, let's check in with each of our cohorts here on the old All-Star panel. See what they're cooking up that may interest you. Jared, in addition to all of your myriad bids going on out there, what else is cooking over there at BGC Partners?
So we're looking at, I've got a study coming out next week looking at the convexity of stock returns in individual stocks relative to where the market moves. So it's kind of like, what's the beta of a stock on the upside when the market moves higher? What's the beta of stocks when the market moves lower? We just draw a straight line through all those on a chart, and do a linear regression. But for most stocks, that line isn't really appropriate. It's more of a curve. So I've been looking at a strategy that takes advantage of those curves, both from a just stock selection approach and from an options perspective. Some really interesting things to be done with that, and coming out with that study next week, as well as the traditional daily and weekly things that we put out.
And Mr. Mark, what's cooking up at the pit?
We've got, just keep reading our blog. We're adding a new section to our blog every day. It's going to be called The Lesson. So we're going to bring a thought-provoking lesson every day to the blog. So make sure it's worth your time and visit. Go to optionpit.com/blog to learn about all things trading and volatility that don't involve this show.
Yes, that don't involve this show. So there you go, listener. Surf on over to BGC Partners, learn more about what Jared has cooking over there, and surf on over to optionpit.com to learn more about what Mark and Andrew have cooking up over there. And on behalf of Jared and Mark, and indeed myself, I want to thank all of you out there in the listening audience for downloading and streaming and subscribing, and of course for sending in such great questions, including, don't forget to send in what the stake should be on that Fed raise or lower great debate. And we'll see you next time right here on Volatility Views.
Thank you for listening to Volatility Views, the premier program for volatility traders. For episode archives and detailed show notes, please visit theoptionsinsider.com/volatilityviews. Be sure to make your own voice heard by leaving a volatility voicemail at 773-669-4VOL. or by posting a comment on theoptionsinsider.com, sending an email to questions@theoptionsinsider.com, or posting your questions to twitter.com/options or facebook.com/theoptionsinsider. Volatility Views is brought to you by Russell Investments, a global asset manager and one of only a few firms that offer actively managed multi-asset portfolios and services that include advice, investments, and implementation. For more information on Russell indexes and RVX, please visit russell.com/indexes.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.